smart people destroy themselves financially. Drinking, relationships that cost more than they return, and, most importantly, leverage. The first two are rhetorical flourishes. Leverage is the real danger. The core point is arithmetic. Anything multiplied by zero becomes zero. No matter how brilliant or experienced an investor is, borrowing magnifies both gains and losses. And a single catastrophic downside move can wipe out everything. Without borrowed money, a bad investment means losing the cash you placed, which is painful but recoverable. With margin or other forms of enforceable leverage, a moderate market decline can trigger forced selling, cascading margin calls, and permanent ruin. Brokers can demand extra collateral at the worst possible moment. If you cannot meet those demands, you may be liquidated at the market bottom and end up owing money. That mechanical asymmetry, limited upside, unlimited downside, makes leverage uniquely dangerous. The history is instructive. Long-term capital management, a partnership made up of Nobel laureates and top quantitative traders, collapsed in 1998 despite extraordinary intellect and experience. Their strategies were highly leveraged, relatively small capital, supported enormous positions. When markets moved against them, following geopolitical and credit shocks, their positions deteriorated faster than they could unwind them. The fund required an emergency rescue to prevent broader market contagion. More recently, Archegos Capital lost tens of billions in value in a matter of days because its highly leveraged bets, conducted through opaque swaps, were suddenly unwound by counterparties. Major banks took big losses. These episodes show that intelligence, credentials, and past success are no defense when leverage concentrates risk and external counterparties can enforce repayment at short notice. Firms and individuals may believe they have hedges and sophisticated models, but models depend on assumptions about liquidity, counterparty behavior, and market structure, assumptions that sometimes break down simultaneously. Leverage's arithmetic explains why markets routinely experience deep drawdowns, 20, 30, 50% or more, and why such moves can be fatal for leveraged positions. An asset that halves in price requires a 100% gain to recover, but a levered investor may have already been forced out. In 1929, easy margin allowed investors to buy far more stock than their capital justified. When prices fell, margin calls created a feedback loop of forced sales that intensified the collapse. Regulators later recognized this systemic hazard and for decades used margin rules as a tool to restrain excess speculation. But financial innovation and fading memories reopen old vulnerabilities. New instruments, total return swaps, structured products, and off-balance sheet arrangements can conceal leverage and evade traditional regulation. Dealers and lenders sometimes willingly enable clients to build outsized exposures because short-term fees and commissions are attractive. This creates an incentive problem. The party who profits from facilitating leverage is not always the party who bears the full long-term cost when things go wrong. The author contrasts two kinds of leverage: enforceable leverage that can be called immediately, and non-callable leverage, such as insurance float or a fixed-rate mortgage. Insurance float, premiums collected now to pay claims later, can be invested and functions like leverage, but because it cannot be recalled on a market dip, it does not force ruinous sales. A fixed-rate mortgage similarly allows long-term repayment and is often sensible because it matches an asset, a home, with a financing structure that the borrower can carry through cycles. The danger is leverage that someone else can demand back at the worst moment. Personal finance principles follow the same arithmetic. Small differences in saving versus spending compound into radically different outcomes over decades. Debt, particularly high-interest consumer debt, works in the opposite direction of compound interest. Credit card balances at double-digit rates destroy the compounding advantage that a saver's portfolio enjoys. The author illustrates how a $40,000 loan at 18% with only minimum payments can end up costing roughly 3 times the principal over decades, while investing that same amount at modest returns leads to far larger accumulated wealth. Human psychology explains why people persist in dangerous leverage, overweighing potential gains, underestimating the probability of ruin, extrapolating recent good performance, and confusing luck for skill. People envy faster apparent wealth and social proof. Neighbors, colleagues, or online personalities who seem to succeed with leverage encourages imitation. Lenders and intermediaries, enticed by fees, may facilitate unsound leverage. The combination of cognitive bias and misaligned incentives repeatedly produces catastrophic outcomes. Given these facts, the prudent approach is upside limited. Avoid risking what you need for returns you do not require. If you are comfortably positioned, the marginal benefit of additional returns gained via leverage is small compared to the potential cost of losing what you already have. Put another way, when you already have enough, trying to double up with borrowed money is usually foolish. Asymmetric downside overwhelms modest incremental upside. The author recommends inversion as a mental model. Instead of asking how to get rich, ask how to go broke, and then avoid those behaviors. Compile a list of proven wealth-destroying actions and simply do none of them. Avoid unsurvivable bets, high-interest consumer debt, and borrowing against volatile assets. Value survival. The most important feature of any financial strategy is the ability to be present at future compound returns. You cannot compound from zero. Practical counsel emphasizes patience and discipline. Steady returns compounded over decades. Single-digit real returns produce enormous wealth over time without needing leverage. The investor who earns a modest 8% annually for 30 years ends up far wealthier than the levered investor who enjoys superior returns briefly and then suffers a permanent collapse. Taxes and fees are secondary considerations to staying solvent and letting compounding work uninterrupted. In conclusion, the text urges humility and the avoidance of needless enforceable leverage. Intelligence and models are useful, but not omnipotent. Capital preservation, patient compounding, and a clear recognition of the arithmetic of leverage are the engines of lasting wealth. Avoid the zeros. Don't let temporary advantages turn into permanent catastrophe.